The Inflation Reduction Act put the automotive industry front and center. And while the headlines have been on EVs, there is another catalyst that most investors are overlooking. Today's EVs look more like smartphones than ever before, and one company could be the driving force behind them. Financial pros have been researching chipmaker stocks, and the third most popular search on Trackstar has been Qualcomm. The 5G smartphone leader is now making waves in the automotive sector. And like most semiconductor stocks, shares have slumped in recent months. Yet, this microprocessor beast stands to benefit from longer-term trends. But is the timing right? Now, Qualcomm is the world's largest wireless technology innovator and developer of 5G. And where Intel and AMD focus on servers and computers, Qualcomm prefers to play in the mobile space, and its technology can be found in every industry. It created the first 5G AI processor, and its expansion from smartphones into automotive is quite new and should create new pockets of revenue growth for the company. Now, from 2015 to 2020, Qualcomm saw little revenue growth, but that all changed in the last 2 years. In 2021, the firm saw its revenue grow by 42% from the previous year on the back of its accelerated 5G rollout. This year, it's on pace to have its highest grossing revenue growth, with 12-month trailing sales at $42 billion. Qualcomm holds $6.8 billion in total cash and has total debt of $15.5 billion. It has an operating cash flow of $8.7 billion and pays out a $3 per share annual dividend. It has plenty of capital to satisfy its short-term debt. Qualcomm is one of the cheapest semiconductor companies around, trading with a 10.7x PE gap ratio, which is well below its 5-year average of 17.9x. And Qualcomm also has gross profit margin of 57.9%, which is incredible for the sector and better than all but one of its peers. And when you look at its net income margin of 30.5% and operating margin of 35.8%, it's clear that Qualcomm knows how to run a business. The firm has an EBITDA margin of 39.8%, and only Broadcom does better at 57.3%. However, none of its peers are close to Qualcomm and its return on equity of 106%. The same is true with its return on equity capital. None of them can touch Qualcomm's 33.9%. After years of struggling to show revenue growth, Qualcomm has stepped on the pedal for the last 2 years. In terms of EBITDA growth, Qualcomm performs well but lags AMD and Cirrus Logic. In our opinion, this is an 8 out of 10 ranking stock. Qualcomm is a dominant player in smartphone technology and has found new light in the automotive sector. Shares of the stock are cheaper than AMD and Nvidia on a PE basis, but unlike those other two, it pays a dividend to investors.